Got Mr. Iyer also joining us from M&M Fin this morning. Mr. Iyer, good to have you with us. Lots to discuss with the kind of trends that we've been observing. But first, now the RBI has issued those draft guidelines with dividend distribution by NBFCs from FY21 onwards. What do you feel will be the impact on the sector, on MMFS in particular?
So in MMFS particular, the impact is not going to be high because we were a 20%, 25% payout ratio company even otherwise. So we continue to remain in that bracket. I think our overall industry impact, I would think that will bring a lot of discipline in terms of, how people look at their capital adequacy, how they look for their provision before they can consider for dividend. I think the whole approach is to bring in a format to the dividend declaration, given the current situation where the regulator possibly wants everybody to be appropriately capitalized and also make sufficient provision for delinquent accounts. So if these two are taken care, and after that you still are left with surplus, you declare dividend is the guideline. So I think it should strengthen the sector from a capital perspective. And as I said, for MMFS in particular, we would be in the Group B, which is a 20% payout ratio situation.
Okay, fair enough. And, going forward from there then, the dividend payout that you will be eligible for, would you be able to share that with us? There have been some concerns on the net NPA as well in the last 3 years. Going forward, does that continue to be a concern?
So if you look at last couple of years, the rural market has gone through difficult times and we work only in the rural market. So that has built some pressure for us. What we see now clearly is easing of that pressure post-COVID. We have seen the sentiments have turned positive. The farm cash flows held up pretty good. We do expect by the fourth quarter, the infra cash flow will also open up. So we do expect correction for us going forward. Even in these difficult times, we have shown correction to the overall collections that we have made. We have also taken an overlay provision, so it's not a real concern. We do very strongly think that the next 3 years for rural should be extremely good given the focus of the government. And that should see us back to what we were in 2019 kind of a situation and then improve beyond that. So for us, our dividend payout ratio is concerned, as I said, we will be in that Group B of the structure that have been put in there, which is a 20% payout ratio.
Sure. Ramesh, historically, Q3 and Q4 are usually good quarters for your company. What are the demand trends that you're observing in your interaction with OEMs, dealers? And are you witnessing an improvement when it comes to disbursements and better collection efficiency?
So clearly, month on month, we have seen better disbursements. The festival season was good. Both October, November saw good demand for vehicle. But as all of us know, OEMs were not possibly able to fulfill the demand. There was some short supply across the country we witnessed for various products. What we understand from OEMs, definitely all of them have ramped up production. Vehicles will be made available. Dealer inventory will start to move up a little. And definitely, you're right, third, fourth quarter is extremely good quarters for rural. Given the monsoon was good, we do expect the fourth quarter demand to be very, very positive and aggressive. That should help us surely from a disbursement perspective. Overall collection efficiency, if you start from April, it was a disaster in April. But as we speak, post that every month there has been an improvement. The collection efficiencies have gone beyond 90%. And as I said in the earlier point, that we will see delinquency coming down over a period of time with both farm and infra cash flow opening up. So I would put rural to be on the positive trend as far as the overall sentiments are concerned. And that should see us through very well even in the fourth quarter.
So what then is the outlook going forward? Given how strong the rural sentiment has been, would you say that a large chunk of your product mix will be dominated by tractors? Where do you see the bulk of growth really coming in from?
See, as you know, we are spread across the country and therefore our approach has always been multi-product approach. And therefore, I don't see the percentages of our product mix substantially changing. Maybe a percentage here and there would happen. Like if we are today 15-17% tractor, will that go up to an 18% kind of a situation? I don't see growth being driven by any particular product. But yes, The pre-owned vehicle demand seems to be pretty good. Again, there, the supply has been a constraint with exchange programs not happening, finance companies and banks not repossessing, so the second-hand vehicle availability was a little low. But I think those things will change, and I would think clearly pre-owned vehicle would drive the growth for us. We are also seeing almost all the OEMs for the car segment reaching out to rural market. We just saw recently we are talking about going into rural market, and we have working arrangements with all the OEMs, and therefore we do believe LME would be one of the segment of growth for us. Clearly, tractor buoyancy continues to be there, but we have a very, very high market share as far as tractors are concerned. We have close to about 35% market share when it comes to Mahindra and Swaraj brands of tractors. We are very seriously looking at pre-owned tractor to grow much faster. We already do about 4,000-5,000 tractors, but I think that can scale up. So it'll be a mix of many, and I don't see a product mix substantially changing from where we are, maybe a percentage here.
Okay. Analysts are expecting asset quality to remain under pressure in the NBFC sector for a while, for about 6 months or so. What's your outlook on NPAs in that context?
So, everyone thought post-moratorium, the NPAs will zoom to a very new high, etc. At least I can speak of the rural market. Clearly, that's not to be the situation. Consumers are coming forward, making payment. Yes, are they able to make all payments on time for every month? The answers could be no. There are some specific segments where I do expect that the NPAs will go up, which is the school bus operations, because last whole year they were not able to operate and they have not been able to earn their money. And when I say school bus, they are not buses owned by the schools, but also the small vans that carry students to school, etc. They have not been earning well, and they are coming forward to ask for extra time. Clearly, we do see commercial vehicle goods segment continue to remain under pressure, and it could take little longer. The taxi aggregators, while they are back on street, but their earnings are not as before. So this segment also would take little time. And the tourist attached vehicle, which ferry people from the main center to the tourist spots, etc., in few of the markets. So if you look at these 3-4 segments may go through some pressure, but they are not a very, very high percentage of the overall volume for anybody. But as otherwise, I would think that post-September, there has been continuous improvement to collection. If you look at every NBFC's collection percentages, everyone has talked of high percentage. So I don't subscribe to the view that the NPAs would be substantially high. But yes, there could be a stage movement happening, under the India's, if you have 2 installments delinquent, though not an NPA, but in stage 2 provisions may have to be provided. And that could go a little up because people are delaying their installment, at least 1 or 2 installments here and there. But I won't subscribe to the view that NPAs would substantially
go. Okay. And with the RBI panel proposing corporate-led large NBFCs to convert to banks, is that something that you would consider?
I think we've said this in the past. Any opportunity that comes our way, we are not going to let it go. We will seriously look at it. What are all the possibilities and requirements? And of course, we will have to study it in detail as to what's the final guidelines come out to be and compare it with the current model that we have. We have a large balance sheet spread across the country. Of course, a very considered decision would be taken by the board once we analyze both the format possibility. But definitely opportunities won't be let go. We will look at it seriously before we reach any conclusion.
Okay. Also, the housing finance subsidiary, if we could touch upon that, there has been growing demand in that segment. Have you seen disbursements pick up on that front?
Yes, definitely. In the affordable space, we have seen some disbursement pick up. As you know, we work only in the semi-urban rural market. The rural demand is yet to start because this is not their priority. So they are settling down, and I'm sure that will start to pick up. But in the affordable piece, we have seen a pickup, and our own strategy is also to improve the affordable disbursement and change the mix of our book from currently just about 10-12% from affordable. Will go up to about 20% of the book going towards affordable.
Mr. Iyer, we'll let you go on that note. Thank you so much for sharing with us your outlook on the RBI draft norms as well as the outlook on the growth drivers for the company and the NPAs.